It's the biggest financial sector collapse since the GFC. Silicon Valley Bank was the tech industry's banker, the 16th largest bank in the United States, with $200 billion in assets. It spectacularly collapsed on Friday night, just a month after Forbes named it one of America's best banks. Aussie startups were exposed to the crash among many high-profile clients. Businesses like Canva, the educational platform Crimson Education, and BHP-backed mind sensor firm PlotLogic. After an anxious 2 days, Treasury Secretary Janet Yellen finally announced customers would have their deposits guaranteed. But she ruled out a government bailout.
During the financial crisis, there were investors and owners of systemic large banks that were bailed out, and we're certainly not looking, and the reforms that have been put in place means that we're not going to do that again.
The move to protect SVB's clients was critical to prevent any further bank runs. So the question is, what went wrong? Well, during 2021 and 2022, there was a major increase in funding for tech startups. About 50% of those startups held their money in Silicon Valley Bank. It was a hot market for tech, and SVB grew fast. Under the US fractional banking system, which is how most banks operate, SVB invested those customer deposits. But it put some of the money into what's meant to be the safest of all assets, long-term US Treasury bonds. And this is where things started going wrong. SVB misread the rate that the startup companies would demand access to their own money. To meet their customers' withdrawal demands, SVB was forced to sell those long-term bonds. These bonds, remember, were bought during 2021 and 2022 in a record low interest rate environment. As interest rates rose, bond prices fell. Today, interest rates have more than quadrupled, meaning the bond prices are worth far less than SVB paid for them. They had no choice but to sell those bonds at large losses to cover customer withdrawal requests. The word got out that SVB was facing a liquidity crisis. It led to an old-fashioned run on the bank. Customers, fearing their deposits might be at risk, started to withdraw their deposits en masse. The losses SVB would incur by selling out early of all these bonds were greater than the value of the bank itself, and quickly SVB found itself insolvent, the regulators then stepping in. Now, this issue became political over the weekend, with presidential candidates among those weighing in about whether or not the bank should be bailed out. Florida Governor Ron DeSantis blamed bureaucracy for ignoring the warning signs and not preventing this in the first place.
In this bank, they're so concerned with DEI and politics and all kinds of stuff. I think that really diverted from them focusing on their core mission. I also look at it and say, we have such a morass of federal regulations. We have a massive federal bureaucracy, and yet they never seem to be able to be there when we need them to be able to prevent something like this.
Republican presidential candidate Nikki Haley argued against a corporate bailout. She said it is not the responsibility of the American taxpayer to step in. The era of big government and corporate bailouts must end. Her rival, Vivek Ramaswamy, said SVB should be allowed to fully fail, and he said the FDIC should increase its guarantee level to prevent a bank run.
Silicon Valley Bank made some uniquely bad management decisions. One of them is, first of all, they have a depositor base that's really concentrated of tech startups in Silicon Valley. A staggering nearly 90% of their deposits are uninsured. That's an anomaly compared to most banks in this country. So what's happening right now is a lot of Silicon Valley executives and VCs this weekend, many of them have even reached out to me, to push this narrative that that's going to create a bank run in America if Silicon Valley Bank isn't actually bailed out. But what they're doing is actually trying to create the fear of one.
And we'll chat to one of the Australian chief executives impacted by this collapse a bit later in the show. President Joe Biden is expected to address Americans about this collapse shortly. In a statement, He said, "I am firmly committed to holding those responsible for this mess fully accountable and to continuing our efforts to strengthen oversight and regulation of larger banks." The question now is, how many more banks or managed funds will go under over the next 12 months? Funds that had it easy when interest rates were low and money was cheap. We will be asking ourselves, have we learned the lessons of the global financial crisis?